Good afternoon, everyone, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno, sending to you live Monday, October 31st. But before we get to the show, just a friendly reminder that today is the last day of our crash sale. We've reduced the price of a subscription to Real Vision Essential to $99 per year, and a subscription to the Plus tier is just $400. Again, it ends today, so make sure to use that chance. But let's get to the interview. We're going to ask the question today, what's next for energy? And I guess no one's better at answering that question than the green chicken. So it's a pleasure to have Mr. Doomberg with us. Good to see you.
Andreas, great to be here. Really appreciate the invitation and looking forward to a great discussion. Big fan of your work, and really it was a thrill when you reached out to have us on. So looking forward to it.
Me too. But let's start with a short-term forecast. I saw that you tweeted that Joe Biden will be on stage in around 30 minutes with a message to the oil companies. What do you think he will say?
So the reporting coming out is that Biden will insinuate that if oil companies don't do more to bring down the price of gasoline at the pump, that he will work with Congress to try to get a windfall profits tax passed. Now, we were joking a little bit before we went on the air that we view this as a consequence of the fact that there is a midterm election next Tuesday, and the odds of such a thing coming to reality are very low. I think the market has mostly shrugged it off, such as the nature of politics the week ahead of a decisive election in the United States, as I'm sure you know. Watching the news from Europe, the U.S. is a hyper-polarized and very evenly divided country, and a few votes in swing states can have disproportionate impact on who wields power in the country. And as we get closer to the midterm elections, we anticipate more and more headlines like these, most of which I think as traders can be safely ignored.
Now that we are talking about politics, one of the things that have been of major importance to oil markets over the past couple of months is the drawdown of the SPR, so the Strategic Petroleum Reserve. What do you make of the Strategic Petroleum Reserve on the other side of the midterms?
Yeah, that's a very great question. We've written a couple of pieces on the topic, and a lot of people don't realize that the drawdown that Biden has done, of course, is unprecedented. Most people know that. He has committed to draw down 180 million barrels, almost 1 million barrels a day over the period of 6 months. But this comes on top of mandated future oil sales that come out of Congress when legislation from years gone by was passed. And this is a little nuance of American politics that energy traders should be aware of. The whole game in Washington, D.C. is to score legislation, to trick the CBO, the Congressional Budget Office's scoring of legislation. And in 2015, Congress, a bipartisan, by the way, both parties are guilty of this, began to realize that they could mandate future sales from the Strategic Petroleum Reserves, and the anticipated revenue from those sales would offset the spending on the CBO score. It's a gaming of the CBO score. And so there's actually something like almost 200 million more barrels of oil to be sold from the SPR over and above the 180 that Biden has mandated. And so there's 30 million barrels in the next fiscal year. There's and all of these mandated sales are 10 years from, 8 to 10 years from where the bill was passed, because they're just sort of snowplowing future obligations to Congress that they don't have to worry about today. And so in addition to the drawdown of the SPR, we're facing a wall of congressionally mandated future sales from the SPR because of budgetary tricks from bills of yesteryear. And so the situation is actually substantially worse than people realize. And as you mentioned, in a post-election world, when all those bullets are fired, the U.S. is going to be faced with a critical question, which is, will they spend the money to refill that SPR? And if so, at what price? And the whole world, knows this. The Saudis know it. OPEC Plus knows it. And so it's a very, very fascinating situation, and one that we're following very closely.
If we look at the current reserve, I think about 1/3 of the overall level has been given to the market basically via this drawdown. But how low can we go? Is there sort of a feasible threshold to target for the reserve level?
So if we just do a sort of finger in the air analysis, there's 400 million barrels left. The U.S. the world uses 100 million barrels a day of oil. The U.S. is it produces something like 12 million barrels a day of oil. So it just give you a sense of the numbers. And in fact, I think these mandated sales are more like 260 or 270 million barrels over and above what Biden has already done. And so in reality, the true sellable reserves of the SPR is probably closer to 120 or 130 million barrels. People can check our numbers, but it's directionally correct. And then there's this question of the structural stability of the salt domes. Most people don't realize that the reserves are actually not kept in tanks. They're kept in these salt domes that have been hollowed out using fresh water by engineers. And if you drain them, there's risk of dome collapse and structural damage and so on. And so it's a pretty risky endeavor. It's never been tried before. It's totally unprecedented. In our piece called Past the Salt, we sort of gave some historical perspective. I think for the first Gulf War, they were authorized to draw down as much as 30 million barrels, but ended up doing a fraction of that because the DOE at the time was more concerned about preserving this strategic asset. That's long ago out the window. Once Congress converted the SPR into just another piggy bank to raid, it began us down this path. And of course, once you go down such paths, taking another 180 million barrels out of the reserves is just another political decision, which is rather unfortunate. But it does leave the U.S. in put it this way: if the SPR was strategically important to have, not having it must be a strategic weakness. And so we shall see. But the rest of the world knows exactly what the U.S. is doing and why. Things have gotten disturbingly personal between Biden and MBS, the Crown Prince of Saudi Arabia, and we're entering into truly uncharted territories. And so we shall see. Our hope is post next Tuesday, after the midterms, everything kind of simmers down a little bit and saner heads prevail, and the political nature of the price of oil becomes less of an issue, and perhaps the long-term strategic interests of the West comes to the fore once again. Politics, as you know, makes for rather unfortunate decision-making under the gun of pressure.
Yeah, fingers crossed. Speaking of low inventories, it's been an ongoing story over the past, say, 2, 3, 4 months in diesel space as well. We've seen how supply constraints, in particular on the east coast of the US, has been an ongoing topic for investors. Let's provide your take on what's going on in diesel space. Is this something that's related to the SPR, and in which case?
So not really. In our view, what we're seeing with the East Coast diesel crisis of supply, and therefore, of course, a crisis of price, is a combination of a logistics issue and a lack of refining in the U.S., mostly actually the former. U.S. refineries are operating at 94, 95% capacities, like historic type numbers. And of course, given the spreads between oil and the refined products like diesel, they're making historic levels of profitability. But in reality, the U.S. East Coast, because of a couple of peculiarities. One, they've been aggressively shutting down refineries in the region. The U.S. is divided into what are known as PADs, a PADD, a legacy of the Second World War and the way that rationing was done by the federal government. And PAD 1 is the Northeast, covers much of the Atlantic seaboard. PAD 1 refineries in that region have been shut down, but because of the Jones Act, which prohibits non-U.S. flagged, U.S.-owned, U.S. sailored ships from picking up product at one U.S. port and bringing it to another. This is an act that is 100 years old. It is literally illegal, since the U.S. actually doesn't own and flag and staff many ships, for cargoes of refined products to go from the Gulf Coast, where the majority of the U.S. refineries exist, and deliver that to the Northeast. And of course, the Northeast has all kinds of environmental regulations against pipelines and so on and so on. And so ultimately, we're heading into crisis mode here, where heating oil, which is basically just dyed diesel, it's all the same refined product, is in very short supply as we head into winter. And then again, much like Europe, the Northeast is praying for a relatively mild winter because if if we happen to get a prolonged cold snap, which we hope we don't, there could be big trouble in the Northeast. And heating oil competes. It's essentially diesel, and diesel is the lifeblood of the modern supply chains, and so it's all very interconnected. But it is a product of predominantly logistics and peculiarities of U.S. Marine laws. The Jones Act, in particular, is an artifact of a century gone by and should be repealed.
When it comes to temperatures, I can guarantee you that I've never experienced a week like this in Copenhagen, Denmark. I've been walking around in a t-shirt over the past couple of days, which is very, very unusual for this time of the year. So fingers crossed for warm weather in the northeastern part of the US as well. We spoke a little bit about the sense of urgency on this topic before we went on air, Doomberg. I told you that my impression from Europe is that the sense of urgency is gone due to the hotter temperatures than seasonally usual. But what about the sense of urgency in the northeastern part of the US? Is this a topic high on the agenda?
It is right now because it is a little early for heating oil to be sort of in peak demand in the Northeast, especially in the past, say, half a dozen years as weather has been sort of historically rather warm. We haven't really had a harsh winter in the U.S. Now. There's been very deep cold snaps, and the grid has teetered in the Northeast once or twice in the past few years. But by and large, who knows? Climate change, pick your favorite explanation, but the weather has been warmer than usual, which is kind of ironic, of course, if Western Europe is bailed out by by global warming as we head into to the winter. But yeah, in the U.S., it's more of a crisis right now again. But you have to sort of try to separate the hyper-politicalization with a midterm election coming up, and so it's difficult to say. Of course, the Republicans are making a disproportionately, perhaps, big deal about it. Democrats are trying to talk it down. I think, once the smoke clears after next week, we'll be able to get a better sense on the ground. But to your point, as we were talking about before we went on the air, as happy as we are that Europe is lucky enough to be experiencing an unseasonably warm late fall, a worst case scenario would be that the lesson that people draw from this crisis is that everything is okay and we could just go on with life as usual. And I think we both agree for Europe in particular, but perhaps the Northeast, these are real serious situations. And if you don't get this right, I really enjoyed your tweet about the relative inflation levels across different countries in Europe, with Spain being sort of the least inflationary of the major countries. And your explanation is one we agree completely on. They're both blessed with obviously a better climate, but also they seem to have gotten their energy policy correctly. They have lots of LNG terminals, and so it's not a surprise to us that Spain is doing better. The worst case scenario would be that luck is misconstrued as intelligence, and then we end up with, say, a cold back half of the winter or a even more challenging 2023, and we learn nothing, and then we just go right back to the same crisis that we are hopefully, knock on wood, looking to be avoiding here pretty soon.
Let's have a look at the current storage levels in Europe, because that's been one of the key topics over the past couple of weeks here in Europe, with falling natural gas prices as a consequence of this queue of LNG ships outside of the Spanish shore and a couple of other countries in Europe. I think you and I agree that this is a short-term story because it is essentially linked to the chart that we can bring up on the screens with fill levels in various gas storages in Europe being very close to 100%. But if we look a bit further ahead, Doomberg, in terms of supply and in particular in natural gas space, what's your assessment of the flows heading into 2023?
So if I look at this chart that you're showing, which is one that we've seen often, and kudos to the European politicians who had the sense to outbid everyone else in the world and get as much natural gas as they could ahead of the winter. That's a two-dimensional chart, and I think there needs to be a third dimension to it, which is the percent that each country has in storage capability relative to their annual demand. So if I look at Austria on your chart, which is what looks to be by eyeball 90% full, they can store something like 74, 75% of their annual domestic needs in storage. Now, much of that is, of course, contracted out. They're passed through, and I'm sure they'll capture a healthy bid-ask spread. But Germany, for example, I think can store something like 23 or 24% of its annual consumption. And so while the numbers look good, and they're as good as they could be, because of course they couldn't scramble to get more storage capacity, although one could argue that looking at LNG carrier rates, that the EU is actually paying LNG carriers to be floating storage to supplement what they have on land, which might not be a bad idea, and it's going to be expensive, but it will be additional molecules that modelers had not anticipated heading into the winter. And so they're basically, creating transient storage options by having this flotilla of LNG carriers parked out off the coast of Spain, waiting to unload, which is, again, not a bad strategy. Congratulations to the planners in the EU for getting that done. The unfortunate part of this story, of course, is assuming we get a mild winter and the EU, the main countries in the EU avoid the worst possible scenarios, they get to do it all over again next year, except much of the storage that's in place today was put there through the physical pipelines that have now been destroyed, connecting Russia to Germany directly, i.e. Nord Stream 1 and at least one of the pipelines of Nord Stream 2. And so the ability to repeat this for next winter, which is probably the last winter of crisis. If you look at futures pricing, by the time we get to 2024, 2025, the world will be a very different place. The natural gas market will be far more efficient, and the crisis will have been largely abated and behind the leaders of Europe. And that would be a very interesting time to look at Europe as a potential investment. But next winter will be a very interesting challenge. And again, the fact that it's warm and the fact that the gas is not needed for heating of homes is a very positive thing. Although at least some of the demand destruction has come from industry, which is going to be a bit of a challenge for recessionary measurements like GDP and industrial activity. And so it remains to be seen whether there are second and third order impacts. But the primary crisis, as we stand here on Halloween, the worst case scenarios are becoming less and less likely, which is an unabashedly good thing.
Yeah, and I can add, if you look at a long time series history in Europe and add the GDP on one axis and the energy consumption on another axis, you get a correlation of close to 1, right? If the energy consumption is down, it's because the economic activity is down. Energy runs through the veins of right about every corner of an economy. But I wanted to ask you about the potential for Europe to gain flows from the LNG market into next year. We know that the pipelines from Russia are basically shut, except for a few cubic meters flowing through Ukraine and the eastern part of Europe. But else the flow is basically zero from Russia now, and Russian flows made up in between, I guess, 40 and 50% of European flows on any given day in 2021. Is it possible to replace all of that gas via the LNG market, and what would the global ramifications be of such a scenario?
So I'd have to run the numbers. There's a lot of floating import terminal projects, and the speed with which Europe is building its import capacity would be the gating factor in such an analysis, in our view. But the natural gas market is a fascinating one to study because you see these wild price swings. Because literally, unlike coal or even oil, it's so transient. Like you either have to store it or burn it. It's very difficult to store. It's expensive to store. Whereas coal, you can just pile it up, right? Which is why, in fact, coal is more valuable on an energy content basis today than even oil, which is really a remarkable first time in history, something that we've written about in our earlier pieces. And so, for example, if you just take the U.S., there's, in Western Texas, at the Waha hub, just last week, with Europe, still paying $30 per million BTU and Asia paying a couple of dollars less than that. Price for natural gas in Western Texas at the Waha hub traded negative because of a pipeline shutdown. And in that region, natural gas is produced as a byproduct of oil production. It's called associated gas. And and the desperate need to produce more oil at the strong, with the strong support of the U.S. Government as they head into the midterms. We have this abundance of natural gas that they literally couldn't get rid of, and with natural gas trading at $30 in Europe, it traded for, I think it closed on October 26th at something like minus 70 cents per million BTU. Just shows you how wild and inelastic the price of natural gas can be. And in fact, we wrote a piece all the way back in June of 2021 where we highlighted that in the great freeze of Texas in the winter of 2020, 2021, the price of natural gas went totally bananas in the U.S. at these regional hubs. And at one hub, the OGT hub, it traded for $1,193 per million BTU on a spot basis. And today, of course, natural gas is trading for $4 or $5. By the way, at $1,200 per million BTU, that's like an oil barrel equivalent price of $7,000. When you need natural gas, you'll pay anything for it. And when you have too much of it, you'll pay people to take it away from you. And the volatility of natural gas swamps that of oil, which swamps that of coal, because it's basically very difficult to handle. And so to your question about LNG in Europe next year, for the right price and with the right levels of ingenuity around moving the stuff around and developing new storage capacities, I'm sure. I suppose it's theoretically possible. The downstream consequence of that would be the rest of the world, which relies on LNG, like many developing nations in Pakistan and Bangladesh and others come to mind, will have to go without. And so there is a consequence, which is the exportation of inflation to the developing world. Because Europe is a wealthy region, it can set a very high clearing price to get the incremental molecules that it needs, and that's what it did this year. And I suspect that's what'll happen next year as well.
We've been talking a lot about the supply side, but let's have a look at the demand side as well. We hosted Shabam Garg last week at the Real Vision platform to talk about long-term demand for oil. I wanted to play a soundbite for you, Doomberg, from that discussion in relation to this long-term view on oil demand. So let's listen to the soundbite and get back to that discussion.
What we mean by the S-curve is when somebody moves from riding a bicycle to then driving a motorbike to then moving or driving a vehicle, your energy petroleum consumption goes up exponentially because it went from 0 to some number. And when you put a couple billion people on that part of the S-curve, the demand growth can be just extreme. So countries like India, Vietnam, the Philippines, Nigeria, think about these countries with huge populations, huge demand. They see what America has. That's what they want. So the demand is not expected to go down anytime soon. If you look back, demand goes up roughly 1% per year, always. And when there are drawdowns, like a recession or a COVID event, demand will come back not just to its level where it was, it will regain that growth because a lot of things are happening behind the scenes. People purchasing vehicles, more roads being built, more transportation equipment, more ships, more planes, more airports.
The entire interview with Shabam Garg is already available at the Real Vision platform for Essential Plus and Pro subscribers. But back to you, Doomberg. This is kind of a message on the long-term prospects for oil demand. First of all, do you concur with his view that the oil demand will basically continue to rise exponentially in the developing world over the coming years? And secondly, how does that rhyme with the supply outlook?
So first of all, we agree. I agree completely with that clip and everything that he said. In fact, we're publishing a piece tomorrow called Exit Stage Left, where we are making the prediction that the world is basically going to roll the dice on climate change. That is our view. Anywhere where significant energy restrictions are implemented, political leaders are either swept away electorally or through violent revolutions. And China is ignoring, China's 30% of global CO2 emissions, and they're completely ignoring climate change. If anything, President Xi in his opening speech at the latest Party Congress was very clear that they will use the resources that China has, i.e. coal, and they will not toss out the old before they're ready to bring in the new, which we took to mean that they will burn as much coal, consume as much oil and natural gas as they need to keep it going. India, same thing. Vietnam, same thing. Even in the U.S., Joe Biden's consistent berating of the oil and gas sector to produce more to lower prices ahead of the midterms tells you that at the first sign of pain, most political leaders in the world are going to revert back to primary energy sources that are the underpinning of their GDP. Like you said, the correlation is perfect, one. And so, yes, of course, to the extent that oil is accessible and you don't think that peak oil is a real thing, the world certainly will continue to demand as much oil as can be economically produced. And we think by 2050, we will be consuming more oil, more natural gas, and more coal than we are today. And ultimately, whatever your opinion is on climate change, the world seems set to roll the dice, which we think, as analysts, it's important to just sort of predict what you think will happen and then let investors decide what the consequences will be. But we think ultimately the world is going in that direction. The Prime Minister of the United Kingdom is not even going to COP27, at least as of this recording. Like, it shows you how far things have turned in just 1 year with just one energy crisis. Now imagine playing that forward 3, 4, 5, 6 times more, and even deeper. The world will set a new record for coal consumption in 2022. We've had 27 COP meetings. We will have had 27 COP meetings after the latest one in Egypt.
Yeah.
This is just as an axiom, as a logical analysis starting point. I think the base case has to be that the demand and supply for oil will continue to grow. Same with natural gas, same with coal.
But if we look at the supply side, say over the next 3, 4, 5 years, and pair that with a growing demand outlook, it almost goes without saying that it looks kind of bullish for prices, right?
Especially when you remove the buffer of nation-state strategic petroleum reserves from the equation. Like, anytime that we hand over market power to OPEC Plus, prices go up. Now, how the underlying equities in the space will perform, or whether you should trade their commodities, or like, this is for each individual to decide in the context of their own portfolio allocation decisions. But it's very difficult, absent a total economic collapse. There's a lot more bullish signs for primary energy in a 3 to 5 year time horizon than there are sort of headwinds, at least as we sit here today.
Speaking of OPEC plus Doomberg, I actually read an interesting article in the Financial Times today. It doesn't happen that often, but they wrote today that Indonesia is pondering whether they should try and sort of form an OPEC plus in the electric vehicle space, so to speak. What do you make of that story?
I read the same story, and it leaps off the page. The story, sorry, I didn't mean to cut you off there, but the story is that they're thinking about collaborating with other countries that produce critical materials that go into the battery supply chain. And, it makes sense. In the Western world, we have, because of NIMBYism, outsourced the dirty business of mining for nickel and copper and cobalt and lithium and all the things that are needed, with the exception, of course, of Australia, which is an interesting topic on its own. But by and large, it's places like Peru and Chile, Indonesia, that have these resources and have a political construct in which developing those resources is possible. We wrote a piece about this lithium deposit that was discovered in Maine. And you can imagine where this piece is going, where this amazing deposit of very high value lithium is situated something like 5 or 6 miles from a really nice ski resort in Maine. And you can imagine, the piece is called Transition to Nowhere. We published it on September 20th. That mine is never getting permitted and will never be operational. And I can assure you that if you and I went on a recon mission to the parking lot of the ski resort, we would find many, many electric vehicles, plugged in and being charged, because the relatively wealthy skiers, at least on a global scale, are doing their part for the environment. And as the crow flies, less than 10 miles away sits a incredible lithium deposit that will remain in the ground forever thus.
Yeah, short Tesla, long lithium. Kidding aside, we have time for a couple of questions from the audience. We've received a bunch of questions, but I'll pick a few here. We have a question on YouTube. a guy called Melson asked you for the prospects for U.S. production of crude oil and natural gas to increase if the Republicans take the House and the Senate in the midterms.
I think the prospects for natural gas look a little better than oil. If you pushed me today, the oil field in particular is dealing with this drilled but uncompleted well situation, where the companies that emerged from the bankruptcy proceedings after the negative oil price and the COVID shutdowns are far more focused on producing cash. Whereas in natural gas, the industry was in the doldrums for so long that they have become really, really efficient, and they can make significant profits at $3 and $4 and $5 per million BTU after many, many years of sub $2 per million BTU natural gas in the U.S. And so the capacity to increase production of natural gas is there. The gating function with natural gas, of course, is pipelines, and this is the weakness that environmental groups are attacking with significant vigor. And this is a subject of a future piece that we have tentatively titled Pipe Dreams. Projects like the Mountain Valley Pass Pipeline are stuck in legal limbo. And this is why, of course, as we said earlier, that natural gas traded for negative in Western Texas at the Waha Hub. But by and large, if you pushed us, correcting for everything, natural gas, bullish, difficult to see how the U.S. substantially increases its oil production from here, given some of the challenges in the shale patch.
I think we've received more than 10 questions on Freeport LNG, so let's spend a minute or two on that topic. We obviously referred to the producer Freeport LNG, which was hit by this fire in its Texas plant earlier this year, but they expect to be back and running by November, late November, right? As far as I'm concerned, at least from the most recent headlines. What do you make of that story? Will it carry repercussions for the natural gas price globally?
It will certainly put a bid under U.S. natural gas in general, depending on regions and pipeline interconnectivity, and will serve to dampen the price of natural gas the export market, which is an unabashedly good thing, and we should hope for it. And so we shall see. Again, the natural gas industry, especially in the U.S., has been suffering under sub $2 per million BTU for the better part of a decade. With the shale revolution, they literally couldn't give it away. And so these types of prices, even at $6 and $7 per million BTU, let alone the $20 to $30 LNG on offer, or as you and I know, at the peak, I mean, it touched $100. It's just crazy numbers for several days. But it bounced between $90 and $100 per million BTU. At these types of prices, these are sort of legitimately windfall profit type for companies that have been brutally become more efficient because of $2 or less natural gas for the better period of a decade. Companies like EQT and SWN, however their stocks do, we can't predict, but they will certainly be minting money at these prices. And the reopening of the Freeport LNG export facility, which I think is probably more like early December, but could be late November, would certainly be bullish for the price of natural gas. Having said that, there's always the political risk that an export ban or an export tapering comes into play as the increase in home heating costs in the U.S. begins to bite. Let's not forget, just a year ago, we were in that $2 per million BTU range. So 6 to 8 now is a 300 to 400% increase. And, it might seem cheap compared to Europe, but it's expensive compared to the last bill the marginal voter in the U.S. paid. And, Elizabeth Warren stands ready with her partner in crime, Bernie Sanders, to stir up some trouble in the Senate and perhaps win a few political points by banning exports. And so there's a very interesting tug of war going on between our desire to help our geopolitical allies while maintaining domestic tranquility.
Yeah, that's a really interesting discussion that we will have to dig into another time. I want to sum up a bit here before we leave you, Doomberg. I think it's fair to say that to really understand the price moves that we've seen in the northeastern parts of the US in terms of diesel, you need to understand the underlying logistics. And it's basically the same when we look at the drop in the natural gas price in Europe. One thing is the warm weather, but another thing is the logistics. So I guess the safe conclusion here is to state to the audience today that to be fully aware of the price moves in commodity space, you need to fully understand the underlying logistics. And I have to say, no one's better at unpacking exactly those logistics than you. So thank you very much for joining us today.
Andreas, it's been fantastic, and I look forward to doing this again. Anytime you want us on, just give me a DM like you did, and I'm happy to jump on.
Thank you very much for that, Doomberg. And as you maybe know, I've made it my trademark to always conclude the show with a meme. And I've actually stolen the meme from your feed today because it is a meme that basically builds upon a meme that I tweeted yesterday. I've made the meme on the left-hand side of this double meme, but I don't know whether it was you or someone else who added the nuclear part of this meme. But I mean, it's just so telling, isn't it?
It is. Yeah, I retweeted from the account that did it, and it was a brilliant addition. And one of the great things about Twitter is Twitter's got a lot of toxicity, as we were joking about before we came on the air, but also it's just sort of the raw brilliance and creativity of a distributed network of intelligent people makes it worth staying on Twitter. And that meme is really fantastic one to go out on, because it really does, for all our talk about fossil fuels, there's a giant obvious answer waiting for us right there, and it's nuclear power.
Yeah, you're absolutely spot on. Thank you once again for joining us, and thank you out there for tuning in. We will be back tomorrow with more in the Real Vision Daily Briefing.